previous life in Brazil, for several years, I was an equity analyst. And once you start modeling, you really start to understand how sensitive the expected price target that you might arrive for a company is to a couple of the major variables. You've touched on one, which is the cost of capital, and the other one is the growth expectation, right?
Right.
And so when we're talking about subjectivity, that is one that I find really hard to accept as a premise, because how do you define, what is the range of growth expectations that you find reasonable for any given company? How do you arrive at those, and how not to think of those as subjective variables at the end of the day?
Great point. And I think this slide speaks directly to your concern. This is actually a stock that we owned back in 2015, Micron, and I believe we bought it at maybe 14, and then, as luck would have it, as soon as we bought it, it dropped to 10 or 9. And one of our clients was asking us, what the hell are you guys doing? Why are you owning the stock? And they did their own valuation analysis on Micron, and they sent us this little table. And the table said, look, we think with some reasonable circumstances, it could be worth 24. But if we change the cost of capital a couple hundred basis points, we change the growth rate a couple hundred basis points, it's only worth 12. And then if we change it the other way, it's worth 60. So we don't think anyone can have any idea what this stock is worth, right? And we said, if we had parameters like that, we would agree with you. If your estimate of intrinsic value is more volatile than the traded price, you have no idea about an estimate of intrinsic value. And I think this is a very common issue with most valuation approaches. It going back to that whole notion of perpetuity. If you decide the value of a company is $1 divided by 0.1, you're saying everything that goes into estimating that dollar never changes. And then you're saying, I'm going to capitalize that forever. And we know forever tends to be kind of a long time, and a lot of things happen between now and forever, right? So our approach is a little different. That's why we created this economic profit horizon. What we're explicitly saying is that wherever you're starting, the one bet we're making is that you're going to end up with zero economic profit. And for the vast majority of firms in general, that tends to be a pretty good bet. There's some firms that consistently beat that. That's why they're a great company, right? That's what makes them such a spectacular, admired firm.
So
That's a great point.
Okay, no, go ahead, Richard. Sorry.
No,
Okay.
yeah, I was just going to conclude. The sensitivity analysis that you showed is something that we used to do back in my equity analyst days. And it's exactly to your point. I mean, you have to understand how sensitive your valuation is to those core assumptions. And at the end of the day, the exercise of creating a model for the company is more about understanding how the company works and how the cash flows and how the balance sheet and all those interactions work, as opposed to actually defining a particular price to that, right? Because at the end of the day, our ability to forecast is very low as it is. And so, thinking that we're going to be able to accurately forecast 5-10 years in the future is nonsense. Understanding the sensitivity of those variables to those assumptions, I think, is the key.
Right. So just a quick sidebar on your point. When you forecast out 5 years and then you kind of capitalize it with a Gordon growth model, the back end capitalization is oftentimes 50, 60, 70, 80% of the answer.
Yep.
And arguably that's the part you know least about, right?